You followed the story of the Fed over many years. The latest development that they're having dinner, they're eating steak. I mean, the timing of this meeting is arguably a little bit alarming.
Well, not alarming, but I think, the Fed chairman and the president sometimes get together. But I think what was a lot more alarming was the political pressure that President Trump put on the Fed over the past few months via his tweets and so on. And it seems that Jay Powell has caved to political pressures and market pressures. So there's a combination of these two.
Hans, it's good to see you this morning. You talk about the Fed potentially caving to political pressures, but lots of people are talking about the Fed caving in to the market's desires when it comes to that dovish U-turn that we saw last week. What do you think about the market reaction? Because it's been so strong. Some people have been likening it to what the market would have done if the Fed had announced another bout of monetary stimulus. Is that reaction, that positive reaction, justified in your view?
The market rally came from a deeply oversold situation, and it was a reaction to the fact that the Fed is indicating a U-turn. And, if you look at the past or this Fed cycle that we just have, rate hiking cycle that we just had, the Fed raised rates 9 times since December 2015. That's 225 basis points. But on top of that, they also reduced the balance sheet by $400 billion, which is the equivalent of an additional 100 basis points. Now, if you raise rates by effectively 350 basis points, that is a pretty strong tightening move, especially when it comes from a low base such as zero. So I think that the past tightening that we have seen could lead to a recession in 2019, and that's what the Fed is starting to see, and that's why we had this about phase.
So what is this going to do to the strength or the weakness of the greenback? And we were looking through your research, and one of the charts that stood out was the dollar index over a 40-year period. And you make the argument that the dollar has gone through cycles of about 6 to 7 years over and over and over again. This is the end of a cycle, in your view, isn't it?
I think the last cycle probably ended in December 2007, and since then the dollar has drifted a little bit lower. So we're talking about real long cycles. This doesn't tell you where to put your money over the next 2 weeks, but we think the dollar is more likely to weaken over the next few years than to strengthen. And I think that's a reflection of an easier monetary policy by the Fed, among others, and of course the prospect of a recession.